Okay.
There we go.
So whenever you're ready, Mario, I'll share your presentation and then just let me know when to switch the slides, okay?
Sure. Thank you guys so much for having me. I appreciate it. Like Alicia said, my name is Mario Monterrey. I'm with Waukesha State Bank. I've been a mortgage loan officer for over 10 years, and I've been in the banking industry for almost over 20 years. I love what I do. I love helping people purchase homes and also be able to refinance and keep with their credits. And hopefully, we can give you guys some information today. I love being able to, when I'm teaching classes or showing these things, you guys, I love getting feedback. So if I'm talking and you guys find something to answer, please just unmute yourself and don't worry to jump in and let me in, because that's when I think the really learning helps everybody else. So, like I said, this is our first time. I'm already thinking things that I missed on putting in here that we can talk about and go forward from there. But yeah, I guess that's Mario Monterrey with Waukesha Bank, and then we can go to the next slide and kind of walk you guys through this. Um, first of all, do we know how many people already are homeowners that are with us? Can you guys give me a thumbs up or something on there, letting us know if you're a homeowner? Or how many of you guys have been pre-approved and are looking then to get that as a home purchase? All right. Probably
I know there's some in here. Yes, absolutely.
Awesome. Okay. Well, so one of the things, you guys, what is a mortgage? A mortgage is a loan used to purchase a home that is repaid over time. So if you purchase a home and you owe money on it, that's to a banker, that's a mortgage. The key points of that are borrows from it's usually from a lender, a bank, or a bigger bank that you have to make your monthly payments to. And typically, mortgages, I know it says they're 15 or 30 years, but I've had some that can be as little as 10 years, 15, 20, or 30, 25, and 30 years. Like, it's usually the breakup. Nowadays, you guys, on those, the termination on those, there's no prepayment penalties. Sometimes one of the questions I get a lot is like, hey, if I pay it off early, is there any fees, or is there a benefit? Yes, there is a benefit to pay it off early. There's nowadays is very rare, unless there's like some kind of um, side lending, that there would be a penalty for you to pay off your loan early. And basically the mortgage is saying that the home acts as a collateral. And so one of the things, you guys, when you guys did your closing, if you read all those pages at the end where it says you have to maintain the house, keep it in the good status and so forth, because the bank is using your home as collateral. And so again, collateral is in case you stop paying, what does the bank get? And that's what the collateral is. Any questions about that?
Can you tell us what are the actual benefits of paying off early? Like, how does that affect me financially?
Yes. So the benefits of that is that you don't interest is accumulated daily. And so one of the things that back in the days, and it was before my time, it used to be like mortgages that people would pay interest first and then pay the principal after a certain amount of payments. And that's not true anymore. And so it basically, and I think I might have we'll talk about interest later, but then I'll go with it with you guys and see how we can calculate interest. And I think it's a very important thing that you can do and say, okay, how much of my payments going to interest, how much is going to principal, and kind of the breakdown of that, to be able to know what you guys are doing with that. One of the things, though, I do want to just throw out, since you brought it up, is that some people think that paying off the home. So there is something that's true, that if you make an additional payment every one additional payment a year to what you're paying, you'll pay off your mortgage much quicker and save a lot of interest. And so, but however, I want to share, I had one customer, I've seen it sometimes where people focus on that and then start racking up credit card bills. They're making extra payments to their mortgages, and the mortgages, you guys remember, is going to be probably one of the lowest interest rates that you're going to get when you're borrowing money. Credit cards are going to be much higher. Car payments sometimes are much higher as well, and so forth. So again, I strongly recommend paying in advance once everything else is paid and already. You don't want to be paying an extra payment to your house where you're only paying 6%, and then having paying a credit card that's paying 25%. And so that's but yes, there is huge benefits to paying it off early in interest, and it can calculate to that. But let's go to the next page, next PowerPoint. So one of the things you guys will know is that your payments and what's usually made up of is principal, interest, taxes, and insurance. And for insurance, and sometimes in some cases there's private mortgage insurance. But those are the four main things that you're going to be paying on a mortgage. Do you want to go to the next? And it's also known as PITI, principal, interest, taxes, and insurance. So what is a principal? So principal is the original amount that you guys borrowed. So for example, if you borrow 250,000, every payment helps reduce that balance. And let me just see here. I think go to the next full screen. I want to know if yes. So what is interest? Interest is the cost of borrowing the money from the lender. For example, and this, you guys, it's very easy. If you have a mortgage, this is kind of how you can calculate the interest per day. And so I have it written down there. But if you have a calculator on your phone and you just want to practice this with whatever loan amount that you have right now, it's easy. So right there's 250. I'm going to just change it a little bit and just say 200,000. Let me see if I can see it. Hold on, I'll go back. 200,000. So let's say your loan amount is 200,000, and I don't know if you guys see it backwards, but it probably is. And then you're at 6%, so you multiply by 0.06, and then equals $12,000. You divide that by 365 days, which is how many days in a year, and that's your interest per day. So if in this case, if your loan, well, let me go back. So if your loan is at 200,000, your interest per day ends up being $32.87 a day. So you can see how the difference between a $250,000 is at $41.10 per day. So determine how much interest you're going to pay in that month. You multiply that per day by how many days are in the month. And so if typically there's 31 days in a month, so on a 200,000, it's $119 would be going to interest. Whatever the remaining is would be going to principal. Does anybody have questions on how to do that? So like, this is something I recommend you guys understand. So like, because some people sometimes tell me, it's like, Mario, why is so little going to principal and so much going up interest? Obviously, over time, and the amortization of it will continue to go down, and you'll see that switches where more principal is going in and less interest as that goes down, because your payment's going to stay the same for principal and interest if you have a fixed rate, and then over time that changes.
So this is what we were talking about then when it comes to paying a little bit more. So, or if let's say you split your mortgage payment, and pay twice a month instead of one time, this is where that comes into play, because you're paying off more of that principal earlier, so you get charged less interest, right?
Correct. So the one thing I do want to let you know, with the paying it twice a month, you have to pay like a month in advance to get that going. And so, but yes, that is correct. And that's how it happens. So like, even if you're putting an extra $10 to principal each month, that's going to multiply and expedite how quickly you pay that and how much you save. And again, I always recommend doing that after you know that you paid all you're not paying credit card interest at 20%. You're not, you have money saved up at 401k or for reserves. Because that's the other thing too, you guys, is now that you're a homeowner, you are responsible, if something breaks or, if something comes down, you want to make sure that you have reserves and you're not just paying it off. The thing is that when you make that payment to that principal, the bank's not going to give it back to you if you said, "Oops, I paid it ahead. I'm in a bind. Can I get that money back because I had paid it ahead?" They're not going to do that.
Yeah. So one of the questions in the chat from Jacqueline is, how can you pay off within 10 years?
Yeah. So basically, it's just calculating. It's amortizing. I have a tool in there. You can go to Waukesha State Bank. There's a tool in there for calculation that you can say, okay, if I want to pay my loan in 10 years, you calculate what your balance is and what your interest is, and then the term, and they'll calculate, okay, this is how much I have to pay my house off in 10 years. And again, I strongly recommend that you make sure that you don't have no credit card debts, that you have money on your retirement account, that you have money for emergencies before you do all that. But yes, if all that's done, then that's when you could go in and say, I'm going to pay this thing off so I don't have to pay that and be on top of that, because that's an option. And that's great. Great question on that. Very good goals. Any other questions? Okay, let's go next one. Next slide. So what are property taxes? So taxes paid to local government based on property value. These taxes help fund schools, roads, public services, emergency services. This normally changes every year. And you guys, most of the times, the change is going to go that your taxes are going to go up. It does happen where they come back down, but then as soon as my experience is that when they go down, the next year they go back higher than what they were before. So, anticipate that as the owner, make sure that you understand that your principal and interest may not change, but your taxes is nothing that the bank has any control of. And to a point, you may have some control by voting. So if you're able to vote, make sure to vote to see how that you have people that control how those taxes go. But again, you're limited to what control you have of that as well. That's definitely something that you want to look into and kind of go to anticipate that change. Anybody have questions about taxes?
I don't see any, but just to re-clarify, because I know this is one of the questions that comes across our desk all the time, because excuse me, people always say, I thought my payment wasn't going to change. And we do explain the only time your payment can change is when your property taxes go up, or if there's a change on your homeowner's insurance and you do escrow, right? So all the
Mhm.
payment is together. But as you stated, besides that, it would not go up, correct?
Correct. If you have a fixed rate. Correct. Yeah.
Okay, thank you.
Yeah. Next slide. So, like Crystal just said, homeowners insurance is the only other thing that's part of your escrow. And again, I think there might have a word for that, and later we'll talk about it. But escrow is where it's kind of like a savings account, you guys, where that money for those taxes and insurance go into it. And you know that your homeowner's insurance protects your home against fire, storms, thefts, liability. And in some cases, the home additional to homeowners insurance, some people have what's called private mortgage insurance. And so there's two different things. You guys, again, a reminder, homeowners insurance protects you. And if you have private mortgage insurance, all that does is protects the bank in case you stop making payments. But it gives you the ability to buy a house with not putting that additional payment down, or sometimes if you have an FHA loan, it's a guarantee from the government that has that there. Um, so those are again the two things that taxes and homeowner insurance are the main things that and why your mortgage might change, usually in March or April when they reanalyze it at this time. So have any of you guys experienced that already? Has anybody been a homeowner for over a year where they saw their payments change?
Yeah, mine just went down actually like $75 a month.
Yeah, I admit mine went down from last year as well. So, but again, I'll anticipate them going back up at the end of this year. So better
There
be in safe
is,
side.
let's see, there are a couple questions in the chat. Let's see. So one is, who should get mortgage insurance? Is it everyone?
No, so like there's different programs that mortgage insurance will take. If depending on the program that you're in, if you have an FHA and you did not put more than 10% down, that's a government loan. And the way that they insure it is that you're going to pay that private mortgage insurance for the life of the loan. It does go down because it's a percentage, and so that private mortgage insurance and an FHA loan will go down. Most cases, the private mortgage insurance, if it's a conventional loan, though it's based on a lot of it is based on your credit. So sometimes private mortgage insurance can be a benefit for first of all, it gives you the ability to buy a house without a lot of down payment. If which is a great thing that we have here in the United States. If you go out, you guys outside of most countries don't offer people to purchase a house with just 3% down or no percent down. And luckily we have that here. And then we have that because of private mortgage insurance that back that up and gets that. So not everybody has to get private mortgage insurance, especially if you pay over 20% down. Usually you're not going to be paying private mortgage insurance, but it allows you to be able to buy a house with only putting 3% down, which is a huge thing, which gets you started. And eventually in a conventional loan, that private mortgage insurance can be taken off. And now that you guys are homeowner, if you're fixing up your home, putting equity into it because you finished that basement, you fixed up that garage, or just what's happened in the last 2 years, the values of home have gone up. You can request to have an appraisal done to remove that. And if you bought a house in the last like 2 or 3 or 4 years ago, you have equity in there that you could potentially remove that private mortgage insurance if you're paying it. And so that's definitely something you want to be aware of. And you please feel free to reach out to me. I'd love to help you with that and just to say, hey, this is what might be the chance, and kind of go from there.
Yes,
Any
and just
questions?
to reiterate, and I do have a question after this, just to really clarify, you guys. So as he stated, the private mortgage insurance helps you to get into that loan, but that is a protection for the bank, for the lender. That doesn't protect you, it protects that lender, okay? So just to make sure, because people always get confused about that. So that's why Mario talks about the fact that eventually it can come off, and then you're not paying that little bit more. So just to make sure, go ahead.
Oh, I was just saying this is one that you want to take off right away.
Yes.
So this one, if you have that equity and you know your house is worth a lot more than you got it, or you did the increase in that, and you know you're paying that private mortgage insurance, give me a call. We can figure it out and see if that's a good thing, and then we can look at maybe even refinancing out of it. So one of the things I do tell my clients is if you're thinking about removing that private mortgage insurance, give me a call first and see what rates are at, because sometimes to remove that private mortgage insurance, they're going to charge you an appraisal fee to go out there to see what the value of your home is. And so that might benefit us, and maybe to do it all at once to get you to refinance to a lower interest rate, get rid of that private mortgage insurance, and then do that all at once. So
Perfect. And actually, that goes right into the next question from Jacqueline. And how does equity work?
Yes. So equity, it all depends on your home value. So when you purchase a house for, let's just say 200,000, and you put 10,000 down, that's 5% down payment. That means once, and your loan's only for 190,000, that means that you have 5% equity. So to get rid of that private mortgage insurance, either your home goes up in value, let's say to 250 or even less than that, 240,000, and your loan's at 190. That's when you have more than 20% equity on your home. And if you have private mortgage insurance, you can remove that. And so that's how that equity works. So either it works by you paying down the loan, or value going, or the properties in your area go up, or you do an additional, you finish the basement, you clean up, do this, something, you redid the kitchen. The kitchens can increase, you added a bathroom. Those are things that increase equity in your property, as long as there's not a loan already against that. So one of the great benefits, you guys, of being a home ownership is that once you have equity, then it gives you another tool where potentially you could take a home equity line of credit to repay or pay for those improvements that you're doing to your house.
And Mario, can you just explain a little bit the difference between the home equity line of credit versus a home equity loan?
Yes. So the home equity line of credit, again, it's the home equity line of credit is like a credit card that it can be used, you guys, and again, there's really not a limit once you get it approved. It's like, let's say your house is worth 200,000, your loan amount, you have it down to 100,000, and you can go up to, in some cases, in some lines of credits, they may allow you to go, at Waukesha State Bank, we go up to 85% loan to value in our home equity lines of credit. And so if you only owe 100,000 and you want to go up to 85% loan to value on a $200,000 home, that's 160,000. So that means you have 60,000 in equity in a line of credit. So the line of credit will allow you to use it up to 60,000. So you're like, hey, Mario, but I only want to buy a car for 10,000. So even though you have that $60,000 line of credit, the banks will only charge you interest on the amount you use, but you have that available if, like, well, how about if I want to buy a $20,000 car, or should I say maybe I want to put $20,000 into my basement and ideally, you guys, that home equity line of credit you want to use to keep up with your house and or make improvements, but other people use it for other things as well, maybe paying higher credit cards, but that's the tool you get when you're a homeowner, which is huge advantage, you guys. I don't know if you guys know, home equity lines of credit are tied to what's called prime rate. And if you follow the market, people that are the government sets up prime rate. And when prime rate goes down, what they're telling you is, like, since you're a homeowner, we're going to give you the ability to get a lower interest rate on that. Now, sometimes it works the other way, where they're like, hey, and we need to control inflation, and we don't need as much money out there. We're going to increase prime rate. So they don't want people borrowing as much money. And so that might go up and down, and that can change. And that's a home equity line of credit where the amount that you use can be used and paid back and used again. But it also shows that interest can go up and down with that. With a home equity loan, it's also against your home. Both of these loans, you guys, is a second loan against your first. So what happens is you still make the payment like the first, but then you have another payment that you have to pay, either a home equity line of credit. And now in the home equity line of credit, they might just charge you interest only, and it's up to you to pay additional to principal. On a home equity loan, so a home equity line of credit is a revolving line of credit, where a home equity loan is an installment line of credit, installment payment. So what that means is like, okay, Mario, I want to borrow 10,000 and I don't want it available again. And I want my payments to be the same. That's a home equity loan, which is different than the home equity line of credit. Um,
So
does that
Mario,
explain it?
yes, absolutely. So one of the things that people always ask is, so if I'm a homeowner and I have a lot of equity in my house, do I
Yes.
have to be in a good financial place in order to access that home equity?
Yes. And so one of the things is, so you bought the house, you did all this work, you have all this equity, values of your property has gone out, and you're like coming to us to get that second. It's like, hey, Mario, I have all this equity. I want to use it to improve my house or do all these things, or I'm end up buying and I want to use the equity. We're going to pull credit. We're going to see if you qualify. Are you able to still make that payment, both payments and all your other things? And qualify for that. Now, it doesn't mean you guys have to have perfect credit, but it has to be at least good because sometimes home equity line of credit we can help you with to pay off those credit cards that have high balances that are probably putting your credit score low. And so you might get a home equity line of credit with a higher interest rate, but once you pay those things, you might get your credit score is going to jump up, and then you can refinance that home equity line of credit to a lower interest rate. And so it's very important, you guys, that after you purchase a house, that you still look at you're making payments on time, that your income is still there. And I always tell people contact the bank and say, like before making any additional purchase and making a huge like a monthly payment to it. Talk to us now that you're a homeowner. It might be more beneficial to buy a car with your equity in your home and pay that off than have a high interest rate on a car. Now, there are some times where it does make sense to get that lower interest rate car, but we'll talk about that and see how that goes and if any other options on that. Does that work? Yeah. All right. Should we go to the next? Any other questions that I missed? Okay, let's go to the next one. What you'll see on your statements. Okay, so once you get a mortgage statement, typical sections include current loan balance. So that every mortgage statement that you guys get, it's going to tell you exactly what your balance is. And so you should be able to see from month to month how that balance is slowly but surely is going down. And then again, you can do that calculation we talked about, and it's going to tell you the payment due date, monthly payment, escrow balance payment. But it also should break one thing it's not in there, you guys. It'll break down how much went to principal, how much went to interest, and you can do that calculation that we talked about to confirm that interest. It should be very close, and depending how many that days they're calculating that went to principal. But again, it's going to tell you your payment, the monthly payment that you're due, how much is going to escrow. So one of the things that in your statement, escrow is an important thing because that way you can see like, hey, my tax bill. When you get your tax bill in the beginning of the month in December, and you see that it changed, you can go on your mortgage statement and say, okay, how much do I have on my escrow? Am I gonna do I have enough? Should I understand that next year then my payment's going to change? Because usually in March and April, the bank, if the bank statement, if your taxes went up, they're going to reanalyze it, and then in some cases they said they'll pay that because most times when you have escrow, you have a 2-month cushion, and so that 2-month cushion is so that in case it goes up, the bank has it, but they're going to want to replenish that. And so one of the things I always get is like, okay, my taxes just went up by $500. Why are my monthly payments going up a little even more than that 500? It's basically because they want to recoup the amount that they took to pay the difference and make sure that if it goes up again next, or if it stays the same, that they have enough for that following year. And so that's where sometimes they have that mistake on that. But again, the mortgage statements are important so you can keep track of that and know what's going on with your payments on that. It'll tell you if you have a penalty, if you're late, they'll say where the late fee is. and that's what's going to be on your mortgage statements. Any questions that you guys see on your mortgage statements that you might have that I can answer?
Someone does have a question. What is a escrow and how does it work? So can you explain a little
Sure.
better about how the
Yeah.
payments kind of go out?
Yep. So an escrow is like basically it's a savings account, you guys. A savings account where when it's escrow, it's specifically like a savings account to pay for your taxes and insurance, and that's it. And there are some cases maybe it's just for taxes and you're still paying the insurance. But that's what it is. It's just that it's a monthly payment that the bank's holding for you. It is your funds. So if there's any extra or the taxes go down, those are your funds that you'll get back. So an escrow, you kind of think of it as a savings account for your taxes and insurance that is your money. And so once either you're done paying the loan or you pay the whole thing off, those funds will go back to you and go from there. Does that answer the question for escrow?
Yes, yes, it is. I had another question that I wanted to ask about the same thing. I also wanted to know, so you said that's a savings account. So once you pay off your home mortgage, that whatever is left over, they just cash you and get out. I mean, so you
Yep.
just send a check or whatever. I mean, yeah.
Yes,
Okay.
but I do want to remind you that that's money that you want to make sure you use because let's say you pay off your mortgage in July. Well, they're going to send you a check for your taxes and insurance, but your taxes are you are not once it's paid off, and if you don't have any other mortgage or putting that money up again into escrow, you're going to be responsible for paying your taxes now that you don't have a mortgage. So make sure that if you get that money, that you don't just it's your money, but you're still responsible for your taxes. And so you want to make
Right.
sure that you have, like, if you get that, put it into a savings account that you will have enough money to pay your taxes when they come due.
Oh, okay, yeah, because there was gonna be another question there, because I was gonna say,
Mhm.
after you pay your loan off, then the
Yeah.
escrow account just closes up then, and then you just have to
Yep.
take it and put it in your own personal savings account. Is that what you said?
Exactly.
Okay.
Yep. And there once you guys go on, and that's a good question. Once you're under 80% loan to value, usually when you refinance, you'll have an opportunity to say, I don't want to escrow and I'm going to take care of my own, which what that means is that your monthly payments are going to be small, are just going to be that principal and interest. And so then it gives you flexibility to say, hey, I'm going to control my savings, but then it's all on you to make your payments on taxes. The thing is, if you don't pay your taxes, they can force price
Take your
escrow on
house.
you, and yeah, and then again, the city can take your home if you
Yeah,
stop paying your taxes too, and so
okay.
that's why they're gonna
That's
make sure
something.
that you're paying your taxes.
Yeah, yeah.
Good question.
That's something.
Thank you
That's
for that.
something. You're welcome.
Another question from Crystal was, if you overpay, do you get it back?
Yes. Yep. Exactly. You do get it back. So, and if the taxes go down, like Pedro said that in my taxes went down, if you're escrowing, there's an overage amount. Now they still have to keep that 2 month cushion in there to make sure that if it goes back up, that they have enough. But if they have more than the 2 month cushion, any money there will go back to you. And then most likely you could use that however you want because you still have that escrow in there. But yes, any over amount would go back to you after the 2 month cushion is there. So remember, you still have to have that 2 month cushion. Good question. Thank you. Cool. Any other ones? Should we go to the next slide? So some important terms, we already talked about escrow, you guys. So I hope that one's good about accounts to pay taxes and insurance. Amortization. And so amortization is one that we were talking about, you guys. that we were talking, how can I pay off my home in 10 years? It's by amortization is the schedule showing how payment reduces your loan over balance. So that's what amortization is showing you what your payment has to be to pay it off in 10 years, or in some, 30 years, 20 years, 15 years, whatever that amortization means. Like, okay, what's my monthly payment going to be to pay this loan amount in that amount of time with this interest rate? And so that's what amortization. Interest rate is cost of borrowing the money. How much are you getting charged to borrow, that money? So that's what interest rate is. And loan balance is amount still owed. And so those are just some words. Any questions, or do you guys like me to clarify any of these? If not, we can go to the next slide. Why paying on time matters, you guys. It matters a whole lot. It protects your credit score. It avoids late fees. It prevents foreclosure. Anybody know what foreclosure is? Want to say?
I think let's get into foreclosure just a little bit because
Yeah.
because it's so easy to fall into, but to get out of is very difficult.
Yes. So foreclosure is where the bank is saying that usually happens after if you're living a primary home, you are protected as your primary home, where the bank cannot start foreclosure until after 6 months of you missing payments. So a foreclosure is where the bank starts to say, hey, you haven't made your payments. We are going to foreclose on you. And what that means is they're saying, since you're not paying us, we're going to sell that house and have it go to sheriff's sale. And we're going to get our money back since you stopped paying us. And so that is a foreclosure. So to prevent that is why you want to continue to make your payments. So with that being said, you guys, what a foreclosure does is that let's say you bought the house for 200,000, and now the value of the home is 250, but you never open a line of credit, like a HELOC or anything, and you lost your job and you have no way to make that payment. The foreclosure is where after 6 months, you guys, I mean, where you don't make payments, the bank will take it over. I strongly recommend that if something happens where you lose your job and you are not able to make your payments, to contact us to see what we can do. Sometimes there's ways that the bank, having that early communication where you're going through a hardship, a medical, something happens, where they can defer your payments while you're going through this and going through a job. It's much better than just not making your payments and thinking that the bank's not going to do anything. Especially nowadays, you guys, with home values going up year after year, you may lose money by not talking to the bank and saying you have an issue. And again, even if it's been 2 or 3 months, just contact them and see if there's a way to work out. Because what you want to do, if the bank goes through foreclosure, they'll sell the house and they'll ring up all these fees. Now, and let's say the bank is able to sell it for more than what you owe, they will put all the fees on top of it, and then if it's worth more, they'll give you whatever's left afterwards. But after they hit you up with a bunch of fees, you're much better off, you guys, that if you're in that position to try to sell your house and go to and try to get that, because you will still, if you sell your house before the bank forces you to, as a foreclosure, to sell it, you're more likely to make money out of it or not lose as much of it, and take advantage of that. Where if you let it go to foreclosure, the bank's going to hit you with a bunch of fees, high fees, and that equity that you might have had won't be as much, and force you to sell you, and they may not get as much as you would if you would have worked with a realtor and put your house up for sale and kind of protect yourself that way. So
Yeah,
that's what foreclosure is.
and also like if you fall into foreclosure, to get out of it, which can happen if you
Mhm.
take care of it right away, but you have to actually pay what you haven't paid. So you don't get to go on a payment arrangement or anything like that. If you owe 6 months of mortgage payment, you have to get out of that foreclosure. You have to be able to pay that off. So
Yeah.
that's why, like Mario said, it's very important that as soon as you know that there may be a problem or you're going to miss that first payment, to talk to your lender, to talk to La Casa so that we can help take care of it right away before it gets too deep.
And sometimes people don't understand they may have options. They have equity on that house, that you don't want to lose that and really understand that, hey, this is not going, maybe I should sell it, and then get yourself back on your feet. You'll still have some money as a down payment and get you back to another house. But keep your credit good to be able to do that. Remember, your credit doesn't just affect your payments on your house. It affects your car insurance. It affects other borrowing things that you can, in some cases it might affect your job. So definitely something you want to keep, why paying on time matters.
Mario, I just wanted to ask or comment that
Mhm.
from my days when I used to sell houses, um, selling your home when you get into that situation, that hopefully most of the people listening will never find themselves in, but uh, selling your home is a better option than actually letting it go all the way through to a sheriff's sale, because like you said, you can come out of it. You can, if the value's there, you have equity, you can actually make some money from the actual sale versus walking away and then, having that hit your credit.
Yeah. And so thank you guys for taking the time. Yeah. Again, and we see it so often, and that's why we're talking about it, that people, don't take advantage. They don't want to say, oh, I thought I was going to I thought I was going to get a job next week. If it's been more than 2, 3 months, just go get help right now. Don't let it go past definitely 3 months. And again, you could get that job that next month, but don't be we understand banking, La Casa, that things happen, and so don't be shy about getting help. And so definitely, should go
I
to
did
next.
have one question, right quick.
Yeah.
Uh, I heard you, talking about the foreclosure, what happened after 6 months. I wanted to know, are you able to sell your house? Because I say that because you already have not been paying your monthly payment. Are you still able to sell it while you're going through that process? As far as foreclosure, or is it going to be
So
very hard for you to sell it?
it has to be, are they able to get the money before it goes to sheriff's sale? Pretty much.
Oh,
That's where it comes. If you have a buyer that is able to give what the bank needs enough to pay them off before it goes to sheriff's sale, then yeah,
oh,
it potentially, you do have that right. But they're still going to charge you the fees. They're going to add that as part of your payoff if you let it go already to foreclosure.
right.
So there's going to be fees, but yeah, I mean, technically you could, as long as it hasn't gone to a sheriff's sale.
Yeah,
So that's,
yeah. Well, before it hit the sheriff, the sheriff's sale,
yeah,
because I know sometimes, uh, we as people, we fall into, may get sick or whatever and lose our job or whatever the case.
yeah,
But I was just saying though, if you do fall behind like that, I heard you say that we should reach out to La Casa or to the bank to make
yeah,
sure, because you all may have something to help us with, because I know a lot of people probably don't know about
yeah,
this, what y'all talking about. And that's why I'm glad I'm on the line. But
yeah,
I just I just didn't know. I mean, that you
yeah,
actually can sell your home and you still owe all this money. So
yeah,
um
yeah.
okay. Thank you.
And I'm glad you're on it. So thank you. Tell others. And I hope that you guys, all this information, you tell your friends and family. And again, opportunity to, there's a great benefit of being a homeowners and stuff, and you get the help. And overall, it helps our society to get more homeowners. So, um, should we go to the next screen? And or any other questions? All right, so missing payments can lead to late fees. You guys, those late fees are no joke. It's 5% of your mortgage amount. So if your mortgage is $1,000, you're looking at least $50 additional late fees. Your credit score damage, making one of the main things. So here's the thing: we talked about getting a home equity line of credit or refinancing. You guys, if you get a late fee, if there's a late, no, I'm sorry. So there's two different things. There's late fees, and then there's 30 days past late. So I want to let everybody know. So to refinance a home, you can, as a conventional loan, you cannot have a 30-day late in the last year in most of the cases. Now, there's sometimes where we may be able to do it if you have one, but in most cases, you cannot be past 30 days. So if you're past, like, that you almost all mortgages have that 15-day grace period. And so if you're past after that 15-day grace period, you might get the late fee. Does not mean that it gets reported as a 30-day late and it's going to hurt your credit. So it's much better to pay a mortgage 29 days and pay the late fee than have it go past that 30 days and affect your credit score and ability to potentially refinance in the future. So again, it doesn't affect your credit score until after 30 days past due. So don't be saying that, like some people say, well, I already got a late fee, I'm not going to pay it until next month. No, pay it, and so that you don't pass that 30-day, you guys. It is a huge hit to have a 30-day late on a mortgage. And again, you're better off not paying your car payment, you guys, skipping your credit card payment, being late on those than your mortgage. Because we could see that maybe you had 2 months that you didn't pay your car, or 3 months that you didn't pay, but you've been paying your mortgage on time. The bank will still get you like that home equity line or refinance you opportunity, because we know that you prioritize your mortgage over everything. But if you're late on your mortgage and you're paying your fancy car because you don't want them taking it away, that's going to be a huge damage to you guys in the future. It's better to get rid of that car and maybe go to something lower than not make your mortgage payment, you guys. It's going to be a big hit on that. Loan defaults, we talked about foreclosures, not be able to use your equity. So again, not making that payment will not, and let's say you lose your job. And this is one thing that I sometimes tell people, getting that home equity line of credit is always better to get it before you need it. So because some people say, I've had it where they have $100,000 in equity in their home, and they all of a sudden lost their job, and they're like, hey, I have 100,000. Can you just give me 10,000 until I get my other job? Well, right now you don't have a job that we can give you that credit, and to do that, even if your credit is good, if you don't have a way to pay a loan, a bank's not going to give you the money. And so that nice things of that home equity line of credit is that once you have it, it's good for 5 years in Waukesha State Bank. And there are other places that might have it for longer, that you don't have to go through that credit report for at least 5 years. So what that means is that you have this emergency tool that in case something happens, you can reach to. So again, very important that you make, but you can't get that if you have late payment, at least the last 12 months, most recent. Now, if it's past 12 months, then there is a possibility that somebody say, okay, well, you've been paying on time again on your mortgage for the last 12 months. We might take a chance, seeing that you had an error, you got back, and so forth. But those are the things about not making a mortgage payment. Any questions on that, you guys?
Yes, I did have a question.
Yeah,
I heard
please.
you talk about the equity. So when is a good time to get the line of equity? After you buy your home
Home equity. Yeah. So a good time is so when you have some is a good time to see if we can get you one to calculate it. Remember, so we can only go at Washington, Spain, we can only go up to 85% of loan to value. So if you bought a house and you only put 5% down, you may not have equity for a while, or unless you got a really good deal or something like that, or you put some work into it. But again, the 85 is the max. I would recommend you wait until you go 80 so you at least have 5%. Usually to do a home equity line of credit, they want to at least have 5,000 as a minimum that you want as a line of credit. So I would recommend to get that line of credit when you're able to, as long as you have enough equity in that house
okay.
to be able to. Good question.
Okay.
Thank you.
So that you get equity by um doing home improvements? Is that what you're saying? Or paying like when you first get your house, or paying like 20% down, or
Yeah.
whatever you pay
Yeah.
down. That's how
So
you get your
remember,
equity, correct?
yeah, so equity can come in different ways, and it's different for every scenario. Did you get a really good deal on that house? And when you get an appraisal, when you purchase a house, it'll tell you what the value of is at that time. Now I've seen it sometimes where I had somebody just this week that bought a house for um 300 and the appraisal came in at 310. That means they have 10,000 in equity, but does not mean
Oh,
that does not mean they have that 15% down. So equity can come in different ways. It can come by you getting a really good deal and your house is valued a lot more than what you owe. And remember, equity is the difference of what the house is valued at compared to what you owe. It's, I guess, maybe let's keep it as simple as that. So equity again is what the house is valued at now, which it could be the value could have gone up, or you got a good deal, or you did some improvements to it that increased the value, or you just paid down a lot of it because you decided pay more money into it. So those are the ways that equity can come about.
So,
And I do want to throw this: equity can sometimes be reduced if you stop taking care of your house,
mm,
you don't do upgrades on it, or your neighborhood starts like if the values of the houses around you stop dropping, your neighbor sells their house for a lot less than what you bought yours for, then that can lower your equity.
okay.
so as you stated, Mario, so purchasing a home where you already have a little bit of equity into that, right? Um, Making your payments as you pay down that mortgage, you build equity because that part of ownership becomes yours, right? So as you're making your payments, you build your equity and then value of the home.
Yeah. And just with that being said, why I am a strong believer that having homeowners helps our society is when you have more people owning their own homes around you, they're all want their equity to go up. And so if you are in a place where people want to pay to move into your neighborhood, that could easily increase your equity because people are willing to pay more to live next to you, by you in your neighborhoods. And so just by improving, like being a good neighbor, and people decide, man, I love to live next to that person, I'm going to pay more, then your house gets up in value. And so, that's the crazy is things that, being a homeowner, you're invested in that your area. And I always tell being a great neighbor is it'll pay off. Literally, being a great neighbor can pay off because people are going to say what great you are and what people are that want to live next to you. and that's going to increase your equity that then you can use to do that and kind of go from there. And
That's
so that's one
actually
of,
that's what Crystal just asked in the chat. Now that you mentioned that, can your taxes go up if someone in your neighborhood sells the house for more than its value?
yeah. So I mean, taxes are an area, and so it could potentially go up by that. But one of the thing about taxes, you guys, is that yeah, if your value goes up, you could do that. But I remember it's not gonna. Sometimes it doesn't jump up that dramatic. It can and it can't, but it all depends on what the budget is for your city. So if your budget for the city goes down, even though your property values went up, your taxes may not change. So it sometimes it does and sometimes doesn't. So there's taxes is a very complicated thing on how that works, but it's never going to be a bad thing if the value of your neighbor's house sells for more. You may pay a little bit more in taxes, but that means you're getting a lot more equity too on your house, hopefully. Does that answer that question? Cool. All right, should we go next slide? Smart mortgage habits. You review your statement monthly, guys. Knowing what your balance is at, seeing the equity going down, creating a household budget. And so again, with that budget, once you know that your credit cards are paid off, you have extra money and you have money aside, go ahead and like Crystal say, pay more into principal so you can pay that loan faster, which earns you interest. And having a budget that La Casa can help you with, I'm sure, and everything is a huge tool to do that. It compounds the use of that, because not only will it help you lower your monthly payments, you keep track on not getting late fees, you get more opportunity to get rewards, credit cards, you guys, by having good credit and so forth, and it's compounds of that. Setting up for automatic payments just gives you that peace of mind that you're going to make your payment on time. So that's definitely an option. I do recommend just to have that. I have mine where it's set up on time, automatic, but I still go in and pay it earlier, just because that's the way I am. But that's a good option. Track escrow changes, like I talk about. If you know what your balance is on your statement and you know your taxes went up, understand that your payments next year might go up as well. Contact your lender if you're struggling, like we talked about in foreclosures. You guys, there's options the lenders can sometimes give you before you get into really bad decisions or situations. And so definitely those are good habits. Any other habits you guys are doing that you might want to share that we can add to this list?
What I do like that you said was that you set up your auto payment, and if you can pay it early, great, because I think it's just the most important thing, because life happens and can get in the way. So having that auto payment, even if you always intend on trying to pay a little early, is so important so that you don't have those missed payments.
Yes. And you're checking it too. So you can see if for any reason the bank made an error. Banks sometimes make error. They might accidentally credit a different person when it should have been you, and you could see with that and kind of late fees. It's good to see those right away. And if you're seeing it every month, you'll be able to get that, because sometimes the banks like it might pass a year and you're like never see it again. And so checking on those a monthly is a good habit.
I would add, Mario, that
Yeah.
I would recommend to everybody to not be afraid to ask for help. So
Yes.
whether it's La Casa or your lender, anytime you get into a tough situation, or whether you lose your job, or you have to buy a new car or something like that, don't be afraid to ask for help. There's help out there. We're always willing to help. I'm sure you're always willing to help, or whoever your
Yes.
lender is. But don't wait, because
Mhm.
that always just, by waiting, it's just going to get worse if you don't
Mhm.
handle the problem up front.
Yeah.
So just know that there's a lot of people out there to help. And that's what we're here for.
Yeah. Thank you. Should we go next slide? Quick questions. Okay. Do you guys use online or mobile banking? How many of you guys do that? Give a thumbs up. Yeah, I love it. I live on it, you guys. Yeah. So, definitely one of the best tools, you guys. You can see if your payment got there. Just imagine just 15 years ago, most people just sent their mortgages by mail or, didn't, it had to log on an actual computer until they got home to do it. Now we have this on our hands, you guys. Take advantage of it for paying cars, keeping your credit, you guys, good. Definitely recommend doing mobiles. Do you know how much of your payment goes to principal? Have you guys calculated that? Check that. It's definitely something you should look into. And again, even if you're paying an extra $10, $5 a month, remember interest is based off the principal. So if you're paying that little bit or more, it's going to help you pay that early. But again, remember to pay off all the higher interest things first. Have you reviewed your mortgage statement recently? Hopefully you can answer it. And do you use auto pay? Things we all talked about.
I think have you reviewed your mortgage statement recently is huge. So many people do not look at those at all. And I think it's so important to open your mail or if you use an online account to check those out and make sure you understand where you stand, how your payments are being reflected towards your mortgage. Now I'm a big person on knowledge is power, and you need to know what's going on and that everything is going how it should be. So I love that. Definitely, you guys review that mortgage statement.
One thing that I didn't add in here, which I'm going to add for next time, is do you know your interest rate? There's so many times I talk to people and they don't know their interest rate, exact interest rate. You guys, as a homeowner, like we talk about, you have the ability to do a home equity line of credit or a home equity loan, which is a second loan, but more important, you have the ability to refinance the whole thing. So right now, you guys, if you bought your house in the last 2, 3 years, rates have been higher than what they were 4 or 5 years ago, and they've started coming down. Understanding that, like me at Waukesha State Bank, we can do refinances where sometimes lowering 0.5% with little to no closing costs might make sense just to get your lower payment. And again, those are things, you guys, we have to learn to take advantage of and be ready for. Now, again, to be able to refinance, you want to keep up with your credit score, make sure your mortgage payments are on time, make sure your debt to income ratios are good. But it's a huge way that a lot of Americans that are homeowners take advantage of the government saying, hey, we want money back in the system. And the homeowners are the ones that are taking advantage of that by just when the government reduces the rate, that allows people to keep more money in their pockets. And so knowing what your interest rate are and what interest rates are looking like is definitely a good option. If you're a homeowner and you bought your house in the last year or two, give me a call. We can just do a quick check to see if we can give you the ability to save money and lower your payments. So that's one of the main thing that you want to make sure what your interest rate is. If you're hearing interest rates are lower than what you have, give me a call. So
Yes. I know one of the questions Crystal had was she knows it's different for everyone, but how much do you recommend having in savings in case something breaks around the house? And before you get into this at all, Mario, I do want to add we are also going to, as part of our post-purchase series, guys, we're going to host another workshop that's going to get into how to budget once you're a homeowner because it's so different, all the expenses you have.
yes.
So we will get into that, but if you have any insight on this, Mario, that would be great.
Yeah, about the budgeting, you're saying? Is that Yeah, I mean, like I talked about, it's very important, you guys. I strongly recommend you guys do that. I still do that because budgeting, you can kind of say, okay, how much are we spending? There's things that us as mortgage lenders, when we got your loan, we don't ask for, but you still got a budget for it. Is like, how often do you go out to eat? How often do you go to birthday parties and you have to buy a present? How much do you spend on your shampoos and all those things, and breaking all that stuff and knowing it is so huge to and benefit to you guys, because you can see where you can save money and expend it and put it here. And then once you have more of it, then you can do the luxury of doing that, because remember, it always costs more when you're paying interest for it. If you have the ability to save on the side, so one of the things is I always I believe it said you want at least 6 months of in reserves. So what that means is 6 months of your mortgage is what you want in a savings account. Ideally, is what I've heard. Have you guys heard anything different? And what do you guys
Yeah,
recommend?
what we recommend, and like I said, we will definitely get into this in a workshop, is that you calculate all of your monthly expenses that are imminent to,
Mhm.
I guess, your survival for the month, right? So your shelter, your food, things like that. We always want to prepare for unexpected emergencies, loss of employment, things like that. So yes, you want to make sure you have enough in your bank to cover your mortgage payment, your utilities, your food, things like that, in case something were to happen. So we always sit down and prep for that. But in addition to just life expenses, guys, there's your maintenance plan, because as homeowners, there are appliances. And so if you're in the middle of winter and your furnace breaks down, or in summer and your air unit breaks down, your water heater, you need, a roof, a siding, things that are important to your home. These are things you want to prep for, because now it is your responsibility. And as we talked about, yes, if you have equity in the home, that's a great opportunity to take a home equity loan, right? But if, or credit, but if you don't and you're not in that position yet, this is when we talk about savings. So we always plan to do it ourselves and use these other resources as a backup, right? So we definitely think that 6 months of expenses is good. And for each homeowner, it's going to be different. When it comes to cost of appliances in a home, because the size of a home will differentiate what the cost may be for those certain appliances. So when we do our budget workshop, we're going to go over those details and we can really get into it with you guys. But as a rule of thumb, try to have 6 months of regular living expenses. Definitely that mortgage, guys, and interest in your savings, because as we saw when COVID happened, unexpected things happen in life, right? And so the first thing you want to do is make sure that you can pay your bills if something happens. So definitely work on it, and we can teach you in our workshop coming up how to start that and continue. So always think about it when you were applying to purchase a home, or if you're still in that process. The biggest thing we tell you is to save. Treat your savings account like one of your monthly bills. Okay, make it a priority. Have a minimum amount that you put into your savings every month. And if you can do above and beyond that, great, but always have that minimum so that every month you're at least putting something into that account, because it's going to help you. And we are creatures of habit. So if you train yourself to do it, it'll work out.
Yes. And then I think the next screen is any questions you guys have that I can help with. I thought this was great. Thank you guys so much for the feedback. I greatly appreciate it.
Yes, we've had some great questions on here, you guys. I'm so excited that we had this as our first presentation. Mario, such great information. Does anyone else have any other questions? And remember, even if you come up with questions later, you didn't think about them today, we can definitely share Mario's information, you guys. You can contact us because these are important questions and we never want anyone to be afraid to ask. Ask before you get into trouble, right?
Yes. Cool.
All right. Well, guys, this is great. We appreciate you so much, Mario. Such wonderful information. As we stated, guys, we are going to be hosting multiple workshops throughout the year. So we'll definitely be sharing that. Watch your emails.
Jody,
So,
I'm gonna reach out to you on Monday, okay?
yeah, definitely.
Yeah, I'll reach out to you on Monday.
Perfect. All right, you guys, thank you so much for a wonderful class, Mario. We appreciate you as usual. You guys
Thank you,
enjoy,
guys.
yes, enjoy your Saturday. And we
Yes.
look forward to seeing you guys hopefully in our next post purchase. Thank you so much.
Thank
Thank you,
you.
guys.
Bye.
Have a good one.
Bye-bye.
Have a
Bye-bye.
good weekend.
You
Take
too.
care.
Just
All right.
us.
Yep, we can stop the recording.